Uncle Ron stuff. Money. Reverse mortgages. I mentioned it in the last one, and I need to clarify what I said about reverse mortgages. Most people don't know about it, don't care about it, don't need it. If you have a home and you have a mortgage on it, sometimes you can have more than one mortgage, first mortgage, second mortgage, whatever. Uh, There'll come a time when you, like if you had medical expenses or something else, if you're not keeping up with your expenses, say you're on Social Security and you got a pension and whatever, but it's just not making it, you can do what's called a home mortgage or reverse mortgage. And the idea is they'll come to your house, they come to you, and they'll take down the specifics of the house, and they figure out what, from their point of view, what the house is worth. Let's say it's $500,000, $500,000. That's what it would sell for, according to them. They then, given your age, they try to figure out what they're going to do is they're going to lend you money. They're going to open a line of credit, basically. They're not going to give you a big lump. They open you a line of credit that you can draw on up to a certain amount. Now that's where the house evaluations say it's 500,000. They'll say that they'll let you draw, let's say half of that, 250,000. Now sometimes it can be very wide. I mean, you have a $500,000 house and they decide that they can only lend you, based on your age, that they can only lend you $150,000. Anyway, they'll tell you what the line of credit up to this maximum you can borrow against the value of your house, and you live in it till you pass away. Okay, and the idea is that once you start borrowing on it, the line of credit, just like a regular line of credit you may have, um, they start the line of credit. You start drawing on it. Say you take 10,000 out first year. You pull 10,000 out of the $150,000 total that they will give you for this reverse mortgage. Okay, you take 10,000 out. Now they add that. That now becomes actual debt. The 150,000 not actual debt because you haven't spent it all yet. I mean, I don't think you could. Maybe they would give you all 150,000 one time. I don't know. It's in the terms and conditions of the reverse mortgage. But let's say you draw 10,000 out the first year. That's real debt. They take that against the total amount that you can withdraw, and the key point is they start applying an interest to the amount that you borrow, 10,000 plus whatever interest they said was going to be applicable on your balance. So now you have 10,000 and interest each month calculated on an annual basis on that account. Now I'm unclear whether the 200,000 total includes interest or not. Probably does. So the 200,000, what happens is you borrow 10,000 and you've borrowed 10. It's like on a credit card. You borrowed 10,000 and now they'll start charging you interest on an annual basis, monthly. You don't have to pay it. Next year you borrow 20,000. You had 10,000 already. Now you've borrowed 20,000. You have $30,000 worth of debt. They're charging the same amount of interest. They're going to charge whatever the interest rate is on the 30,000, and that's going to be accumulating the whole time because you're not making payments on it. Okay, you understand? You're still living in the home. You're not making any payments, and the debt is accumulating, and it is in fact the mortgage the other way. Where you have a real mortgage, it's reverse mortgage because they gave you money to start with, but it's toward the credit of the. So anyway, you borrow whatever, you live whatever. And when you pass away, unless there's special terms and conditions that cover your spouse or a relative or whatever, when you pass away and they get notification of death certificates, okay, they get that. They then literally call the loan. Whatever you have borrowed over how many years you've lived there, whatever, say it's $100,000. It's $100,000 plus all the interest. If you had it for 10 years, it would be 10 years worth of accumulated interest that you would have to pay back. And you typically, on these sorts of things, if you don't have another person involved with the reverse mortgage, just you, then whoever inherits that house will have to pay within some period of time, has to pay off the debt to the reverse mortgage people. Okay? That may result in the beneficiary who inherited the house to sell the house to pay off the debt that's owed. Now, I made a mistake earlier. I said, okay, at time of death, you know, the whatever you had in the line of credit, that's all it was going to be, and that's not true. What really is true is the time of death, the inheritor, the executor, whoever it is, has to pay off whatever debt you've accumulated being draws from this line of credit. And if you can pay it off with other money in the estate, fine, but if you can't, you have to sell the house and pay that debt off, and then the money that's remaining could go to the beneficiaries, whoever they might be, in your will or whatever it is. So the main points here that I want to make is, first of all, if you are married, you need to include your spouse, and I don't know the right terminology for this, but the how home mortgage should cover, a reverse mortgage should cover both of you. So at the death of the first spouse, the second one doesn't have to pay whatever accumulated debt is there against that line of credit you had. You don't have to pay it right away. The line of credit, the reverse mortgage continues to the death the second spouse or a family relative, however you got it, the terms and conditions of the reverse mortgage. And if you certainly have a spouse, you should have it so that both partners, the debt would be required to be repaid at the second death, not the first. You don't want to do it that way because your wife then would probably have to sell the house to pay off whatever it is, unless you have other assets and you could throw it over there. So, again, I was incorrect in that at the time of the death, the inheritor, you don't lose the house. I was wrong about that. What happens is whatever total amount of debt that you've accumulated by these draws against the line of credit plus whatever interest has accumulated on that debt, you have to pay within a certain time period after the second death of the reverse mortgage signature people, whoever it was, you and your daughter, or you and your wife, whoever you were put on the reverse mortgage thing. Well, that's when they have to pay the debt off within a certain period of time. If they can do it without having to sell the house, and that's great. That's all, and that's the end of the mortgage. So the point I'm trying to make is, one, you're drawing money out of a line of credit, okay, up to a certain amount that the reverse mortgage people have defined to you, 200,000, 300,000, 50,000, whatever it is. And it can vary from reverse mortgage lender to reverse mortgage lender. If you have $1 million house and you're paying taxes on $1 million, they won't say your house is worth $1 million. They're going to say your house is worth 700,000, and they'll base how much they'll lend you on that number, not the million, not what you could sell it for or hopefully sell it for at that point in time in history. Okay, but the real deal you need to keep in mind is once you start drawing on it, it starts accumulating interest. You don't have to pay anything during that period, but interest accumulates. And interest accumulates on the total amount. So if you borrowed 10,000 at 10% interest, the first year you would own 11,000. I think it's 10% of 10,000. You'd owe $11,000. If you didn't draw anything out the next year, at the end of that year, it would be 10% of $11,000, which would be another thousand, whatever it is. That gets added on. And then the next year, you didn't borrow any more, but you now have an outstanding debt to them of 10,000 you originally borrowed plus the first year's interest that was charged because you whatever period of time you had it out, and then the next year it's on that plus the interest that you didn't pay on the first year. You understand? It accumulates on itself. So if you borrowed 10,000 for 10 years, and you just say, well, I'm going to pay it off now. I got money, I'm going to pay it off. So you say in your back of your mind, well, I borrowed 10,000 for 10 years, I owe them $100,000. No, you don't. You owe them whatever it is. In the worst case, it depends when you borrowed the money. If you borrowed 100,000 in year one, and this is 10 years later, you're going to owe them. You'd have to use a spreadsheet or a calculator to figure it out, but each year you're going to get charged whatever interest rate is on the outstanding balance, and the next year you're going to get charged the interest, whatever rate, on the outstanding balance, and that outstanding balance includes the prior year interest that you didn't pay, and so on. So the debt can accumulate faster than you think. That's what I'm trying to get at. You have to keep in mind that you're going to wind up paying interest on interest for the term of that reverse mortgage. You're eating the principal of your house because at the second death, the house, that loan has to be paid off. And typically what happens is the house has to be sold to do that. So you're eating up basically a principal that's in your house, worth whatever it is. It's not simply you're paying back the amount that they said, okay, you could have $200,000 over the life of the period that you lived there. That's the other issue is that if you use up to 200 grand, you have no more to draw on there. That's it. That's all unless you deal with them some way and they write you a different reverse mortgage, and I guess that's possible. But the point being is when you reach your maximum amount that they'll lend you via line of credit, you can't draw anymore. Okay, and you either have to, pay off the loan. I don't know. It would be in the terms and conditions. Once you've drawn all the amount that you're allowed to, they may require you to pay it then. I don't know. That would be something in the terms and conditions. It probably varies from type to type. Anyway, reverse mortgages in certain cases work. Again, you're in your 80s, you can't make all of your monthly bills, or you can, but you want to treat yourself to a vacation or a trip around the world. And you could put it on a credit card, but they charge like 25% interest. If you do a reverse mortgage, they charge only 8% interest, whatever it is. And you could take $30,000 out and do that trip of a lifetime. That's all fine and good. Make sure you understand that interest will be accumulating on that balance that you took out of that line of credit until something. Either you pay it off somehow, or you pass away and your inheritors have to pay it off. It has to be paid off at some time. It's not going to be forgiven by anybody. I don't know. It could be true that reverse mortgages are sold. One company, whoever wrote the loan for you to start with, he may, after a year or two, it's only getting, he wrote the terms for 6% at the time that you signed the paperwork, but now interest rates are up to 8%. So he would sell that 6% loan to somebody else at a discount. But there are buyers who are willing to take that debt that's paying 6% annually. There are people who'll be willing to do that. He sells the debt off. Now he can start lending money again at 8%. So it depends on the interest rate. If the interest rates go up, the debt may not be able to be sold. Nobody's willing to buy a debt that's only paying 6% when you can lend out new money and get 8% on it. All right. On the other hand, if it went the other way and interest rates drop down, then your mortgage at 6% would be more valuable to another buyer. I'd really like to get 6% of my money, because if I lend money now, I only get 3% or 4%. But if I buy this loan from you, the lender, then I can get 6%. This has to do also with investment and trading or investing in debt. The government borrows money all the time. The state, local, federal, they all borrow money. The same thing's applicable here. If you buy a debt like a bond, that's basically an IOU from the government, or you bought a debt instrument, a mortgage. I mean, it'd be the same thing. You buy a debt instrument, and it tells you the rate of interest that it's going to pay for whatever period of term, 20 years, 30 years, whatever. Once you've bought it, if interest rates go down, that debt instrument, that bond, that mortgage can be worth more, and you could sell it to somebody else for more than you lent, the money that you lent out, because it's going to pay off 6% for some period of time, and the buyer says, that's a really good deal, because right now all I can get is 3%. If interest rates go up, then the bond instrument that you hold to the state of Virginia or to the U.S. Treasury, the value of that will go down, because you can't sell it readily. You can sell it, but you can't sell it readily for what you paid for it, because who would invest in something that's only paying 3% when they can go out and buy a new bond from the United States government? It's paying 6%. Anyway, that's a side issue having to do with debt and debt instruments and mortgages. Which is one. Business loans, reverse mortgage. I wanted to clarify the point on reverse mortgage. It is not a terrible idea. I think in the back of my mind is my ace in the hole. I own my house, don't have any mortgage. If something really, really bad happened, like severe medical bills, for instance, it's easy to rack up a $200,000 medical bill if you had heart surgery and no health insurance. How would you pay that off? How would you deal with it? So, or, inflation goes crazy, food and all your utilities, and you're on a fixed pension. Social Security is more or less fixed. There's a cost of inflation increase some years, some others not. Your pension is fixed. It has no rider to increase with inflation. 20 years after you've retired, it's just not cutting it anymore. You're short money. You can't really do anything. You can't travel. The car is bad. You need a new car, but you don't have the money for it. Reverse mortgage is kind of an ace in a hole like that, but you have to keep in mind that interest is accumulating on the outstanding balance that you have borrowed against that line of credit. And two, depending on the terms, that loan may have to be paid off when you have eaten the full value of that line of credit or at your death, and only yours if that's the way it was written out. And whoever inherits your property may have to sell that house to cover that reverse mortgage, and that may not have been what you had in mind. You wanted to give this house to your only child. They get this house, they can live in this house. But if you have a reverse mortgage, your inheritor, your son, your daughter, whoever it is going to have to deal with that reverse mortgage balance. How do they pay it off? Again, if you have other assets and they don't need to sell your house, great. But keep it in mind, interest is accumulating. If whatever balance, if you set up where you can have a line of credit for $200,000 and you use it all up, you're going to owe them, especially if you live long enough, you're going to owe them a big chunk, more than $200,000, a whole lot more. It's just like if you get a 30-year mortgage today for $400,000, by the time you pay it off in 30 years, you will have paid almost $700,000 or $800,000 to borrow that amount of money over 30 years. The same is true on a reverse mortgage. It accumulates, and you're going to pay a lot of interest over the period of time that reverse mortgage is in effect. That's all I got to say about it. It doesn't matter to most people, but it can be nice on the hold if you're old and you have trouble. Be aware that there are some scammy people that do this on an individual basis. They have enough money and they like to do it. They invest in homes this way. And when it's time to pay the debt off, they might swoop in and say, hey, look, we'll take care of this. You don't want to go through the hassle of putting your house on the market and selling it, and then you got to pay the commissions to the buyer or the seller and the real estate people, and blah, 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 blah. So we evaluated a house 20 years ago at $700,000. We'll give the inheritor $600,000 and we get the house. They can do that sort of thing legally, and you just have to be aware of it. That's all. That there are people who would take advantage of you if in certain situations, and paying that reverse mortgage off at the time of the death of whoever was signed on to the reverse mortgage. That can be a susceptible time, especially a beneficiary who doesn't know anything about reverse mortgages or what the terms and conditions are of the reverse mortgage, and that they have to pay it within a specified period of time, and blah, 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 blah. That's enough for today. I thought I was outside and I had enough of that. So it's the 6th of November, 2023, and this is all continuation of Uncle Ron and stuff and money, and believe me, there's a ton that you do need to know about. Even though you don't, maybe your parents have a reverse mortgage and you don't even know about it. And you might want to ask them that if they have a reverse mortgage. They may not have told you. I don't know. You should have discussions about money with your children, and your children should have money discussions with you. There's no sense keeping it a secret, especially not from your spouse. You ought to be open about this stuff. Somebody's going to have to deal with it. That's all I got to say is Uncle Ron and stuff, the 6th of November, 2023.